Hi guys, welcome back to my YouTube channel. My name is James Pakyon and this is Pakyon FX. So guys, thank you again for joining me. The previous week has been very overwhelming. I haven't been able to make videos, but Merry Christmas and I hope you guys are doing well. Today I'm back again with another very educational video, and it is aimed at everyone who wants to start Forex trading. So today I'm going to talk about the basics of Forex, or rather the things that are essential for you to know, the basic terminologies and how things go around in the Forex market. And hopefully you guys are going to learn a thing or two, so stay with me. And before you continue this video, please subscribe to my YouTube channel, and I'll be very grateful for that. So guys, today I want to talk to you about a few things, and I just want to go over a few terminologies that are used in Forex so that you guys can get a basic understanding of how the Forex market works. So guys, I want to talk to you about the first thing that you're going to hear being talked most about in the Forex market, and that is the PIP. So a PIP is a point movement in any currency. So if, for example, you're trading GBP USD, as you can see here on the screen, the difference when you're quoting any currency, for example GBP USD, you're going to notice that it has 5 digits after the point. So for this example, 1 GBP is equals to 1.34678 USD. So in the Forex market, we don't consider the very last digit, so the 5th digit after the point is not considered. So we only consider the first 4 digits after the point. So for this example, we're only going to consider 1.3467. So the difference between 1.3467 and 1.3478 is going to be the difference between the last 2 digits. Okay, so for this example, we are going to say we've moved a difference of 11 pips. So the difference between 3478 and 3467 is 11 pips. So for this example, we actually just consider so the difference between the numbers after the decimal point. So for this example, as we've said, 1.3467 and 1.3468, that the difference is 1 pip. And in other currencies, you're going to notice that they only have 3 digits after the decimal point. So in this example, GBP JPY. So GBP JPY is usually quoted as, so the current market price I suspect is around 140.216. So normally in these types of currencies, we only consider the 2 digits after the point. So we are going to only consider 140.21. We're going to leave out the last digit. So if this currency moves 1 pip, then it means, for example, if it moves 1 pip in the upside, then we are going to quote it as 140.22 from 140.21. So the difference between those last 2 digits make up 1 pip. So leverage. What is leverage? Leverage is a way for traders to trade much bigger than their account. So you're going to notice that when you're taking place in any trade, you're trading against the world market where a lot of currency is being moved, and for retail traders, we don't trade using that much money. So the broker assigns you a particular leverage. It's up to you to choose. You can choose anything between 1:50 all the way to 1:1000. For me specifically, I've taken 1:400 leverage, and this just allows you to be able to take place in a bigger market share with your small account. So that's ideally what it means. Normally it is assigned by the broker, so it's not for you to, it's actually for you to choose, but it's the broker who decides. So most brokers, you find that their leverage only goes to 1:400, and if that's the maximum, then if you're registering with this particular broker, then that is the max that you can get into the trade with. So number 3, currency pairs. Currency pairs are generally, every currency is traded using one base currency and one quote currency. So a currency pair is going to consist of 2 currencies. So for example, in my example here, GBP USD, the base currency is GBP and the quote currency is USD. So 1 GBP is equals to the number of USDs being listed. So you're going to notice that in currency pairs we have two types of currency pairs. We have the main exotic pairs and the main pairs and the exotic pairs. So the main pairs consist of the currency pairs which are being traded the most in the world, and that includes currency pairs such as Euro USD, GBP USD, GBP JPY. Exotic pairs are pairs that are not traded as much, and these include currencies such as USD Kenya shilling, USD Turkish lira, and so on and so forth. So number four rather, trends. So a trend is generally market direction. So if you notice that the market is moving upwards, rather it's making higher highs and higher lows, then we term that as an uptrend. If the market on the other hand is making lower highs and lower lows, then we term that as a downtrend. Lot size. So lot size, a lot size is basically it's the multiple amount, or rather it's the minimum unit that you can enter into a trade with. So lot sizes are categorized into four. So we have a standard lot size, which is 100,000 units, and that is a lot size 1. So for every 10 pip movement in using lot size 1, then the equivalent amount of dollars is $100. So for every 10 pips, if you're using lot size 1, then the equivalent amount of dollars is 100. Mini lot is 10,000 units, and which is equivalent to 0.1, lot size 0.1. So for every 10 pip movement on a 0.1 lot is equivalent to 10 USD. The third is the micro lot, which is 1,000 units, and that is actually the minimum lot size that you can enter a trade with, especially if you're trading currency, and that is lot size 0.01. So for lot size 0.01, if currency moves 10 pips, then that is equivalent to $1. So moving on, broker. I've explained this before in the previous videos. So a broker is basically an entity that you use to access the live market. So you as a retail trader by yourself, you can't be able to access the live market. So you need to go through a broker. So a broker, they just have to be verified by the financial institutions. And here in Kenya there are a few, and there are also others in other countries. But I would recommend you to open a broker with I'd rather you open a Kenyan broker, because it's much easier to deposit money into your account and also withdraw to the various methods such as M-Pesa. So the next one is a spread. So a spread is something that you're also going to hear being talked about in forex trading, and a spread basically is the difference between the bid price and the ask price. So for every currency pair, TradingView doesn't show, but if you check your MT4, whenever you open a particular currency pair, you open the chart, you're going to notice it shows two prices. One is on top of the other. They actually just move together. So the difference could be 1 pip, 2 pips. So that's basically the spread. Most brokers nowadays don't charge on commission, so that is where they get their money from. They get their money from the spread. So whatever current market price that you're going to open a trade with, most of the time you're going to notice that it enters automatically into a loss. That's because it covers the spread first, and then now we'll be able to move to your direction. So orders are basically the executions that you put on your MT4, and they're grouped into 4. So there's a market order, there's a limit order, there's a stop order, and there is a stop loss and take profit. So a market order, when you enter any trade using the market, when you execute a market order, basically you're telling your MT4 to execute the trade based on the current market price. So if the current market price is, for example, 140.217, then ideally if you place a market order, then that means that you're going to enter the trade at that particular currency rate. A limit order, basically you set this to be able to allow you to enter a trade when the price moves back to your desired position. So for example, the currency has moved to 140.256 and you wanted to open your trade at 140.200. So what you do, you just place a buy limit order. In the event of a pullback, then ideally the price will go down, hit your buy limit order, and then now that means it's going to open the trade at the price which you've set, and then now it can move with your trend. Another limit order that you're going to hear about is a sell limit order. And a sell limit order, basically you just set it where you want the trade to be executed at. So if it's a sell, if you want to take a sell in a particular trend and it's already gone past where you wanted to enter, and you're suspecting that there might be a pullback, you just place your sell limit order at a particular price, and then when the trade comes back, it executes your order and then goes with the trend. Another order that you're going to hear about is a stop order. So stop orders are mostly set for breakouts. So if you suspect that if price breaks a particular resistance point, then it is likely to continue moving ahead, then you just place your stop order on top of that particular resistance. So when the price moves past that particular market order, then it will execute at that price. The difference between a limit order and a stop order is a limit order is set after the price has already gone. So you just set it for the event of a pullback. A stop order on the other hand is set where the price hasn't reached it. So what your analysis basically is saying is that if the price continues to move in this particular price in this particular movement, then I want to enter a trade and then continue with that trend. So lastly is a stop loss and a take profit, and this is very essential when you're taking any trade. So it is always essential to set your stop loss and your take profit. Stop loss basically means that if a trade goes against your analysis, then you've set a point where it will take you out without having to take all your money. And a take profit, on the other hand, if the market you've already taken a trade, for example a buy trade, you set your take profit where you want the market to take you out once you've reached the number of pips that you had anticipated or you want to achieve in that particular trade. So for example, if your stop loss is 20 pips below your current entry point, and your take profit is say 60 pips, then once it hits those 60 pips, it's going to take you out together with your profit. And if, for example, it doesn't go the direction that you had anticipated, then it will just take you out without having to cause even more damage to your account. So lastly, guys, margin is the amount of capital required to open and maintain a new position. So of course, you have a small amount of capital in your account, then your margin is going to also to be low. So you can't open a particular lot size of a particular trade. So for example, if you have a $20 account and if you try to open a lot size one, ideally you're risking too much. The broker won't allow you to open that size of a trade. So ideally you'll have to size down your lot size, say enter with a lot size 0.01 or lot size 0.02. Also, you're going to notice that margin calls, when you've over-risked your account and the trade is running and the trade is going against you, you may have things such as they're called margin calls. So margin calls are done by the broker, and they usually just tell you when you're about to blow out your account. So margin calls might take you out of a trade before all your money is gone. So guys, I hope you enjoyed this video. I am really grateful for you joining in. I hope this was educational to you guys. For those of you who want to go into forex trading and into trading currencies, indices, I would just want to tell you that this is possible. Other guys are doing it, I'm doing it. So if your intention is to get into forex, then by all means, but just make sure you have the correct information and just do your research. Take your journey as you can. Don't fall for scams. Don't be told that your money will be doubled. Just maintain that consistency. Be in the charts often. Try and figure out your currencies, your currency pairs, and I'm assuring you that you're going to be successful. So Merry Christmas, guys. Thanks again for joining, and I will see you guys in the next one. Peace out.